please.
Okay, thank you very much. I'd like to talk about work that involves incorporating banking in macroeconomic models. You can think of the objective of this work is to adapt the models to help account for financial crisis like the recent one. In terms of Ellen McGrattan's discussion last session, think about this as an effort to try and figure out what's going on with the risk premium residual. Now, the emphasis is going to be on banking, since we know that most major crises feature banking distress. A second goal is to use the model to provide policy insight for response to crises, that is both lender of last resort policies and also regulatory policies. And the idea here is we'd like to get to the point where we could use the models to simulate these kinds of policies the same way we simulate the effects of conventional monetary and fiscal policies. All right, now it's useful to begin with what goes on in the standard models. And here, to a first degree, aggregate spending, everything else equal, aggregate spending varies inversely with the cost of capital, where expectation of RK is a required return to capital. Now, because financial markets are frictionless, arbitrage is going to drive the discounted excess return of capital over the riskless rate to zero, where M is the stochastic difference discount factor. And you can show from this equation that to a first order, the required return on capital is going to vary 1-for-1 with the riskless rate. In these models with nominal rigidities, the central bank regulates the riskless rate and so has a lot of control over the cost of capital. And the important thing is that financial structure is irrelevant to this process. So the idea behind modeling crises is to generate fluctuations in the cost of capital that are due to changing financial conditions. And of course, the idea here is to introduce limits to arbitrage. And here we have in mind some kind of financial constraints that are going to limit discounted excess returns from going to zero. So how can you think of a financial crisis? Well, it's a sharp tightening of limits to arbitrage that introduces a sharp increase in excess returns. The rise in the cost of capital then has a depressing effect on economic activity. Now, of course, there are other reasons excess returns can move, but the idea is that in a crisis, it's some kind of unwinding of financial markets. Okay, where do banks come in? Think of banks as intermediating between savers and borrowers, and let's let RB be the bank's marginal cost of funds. Now, one can imagine banks facing frictions obtaining funds from depositors, non-financial borrowers facing frictions obtaining funds from banks. And with limits to arbitrage in each market, you get a double-decker set of excess returns. So how can we think of a banking crisis? Well, the banking crisis is a sharp rise in the excess return on capital that's due to a sharp increase in the excess cost of bank funds, where the latter is due to some kind of disruption of banking. And I would argue that the recent crisis fits this pattern for excess returns, where we use credit spreads as proxies. So here, I'm plotting the excess bond premium. What's the excess bond premium? Well, it's a measure of a credit spread with default premia removed. So the virtue is, it's not the case that it's moving around to signal default. It's a kind of excess return in the spirit of what I was talking about in the previous slides. Now here I plot two excess returns. The blue is the non-financial excess bond premium. The red is for financial companies. And several observations. First of all, these excess bond premia are countercyclical, but they went way up during the Great Recession. And if you think of the movements in these spreads as reflecting increases in the cost of capital, it can help explain the contraction in spending over this period. The other thing I'd like you to note is that the financial excess bond premium actually leads the non-financial bond premium and goes up by about the same amount, suggesting that maybe some kind of disruption of financial intermediation is the driving factor. So these are the kind of things we're going to want to try and capture in a model. All right, before I turn to modeling, what exactly do I mean by banks? Well, these are intermediaries that hold imperfectly liquid assets. They're highly levered with short-term debt. And we're going to focus on banks reliant on uninsured deposits, so shadow and large commercial. And we do so because these are the institutions most susceptible to systemic financial distress that affects the real sector. Okay, so let me sketch the bare bones of what goes on in these models. Think of banks that are holding assets QK. They fund them with equity and deposits. Equity is assumed to be costly to issue, so the marginal form of finance is deposits, which you can think of as short-term debt. So what's going to limit short-term debt is an agency problem between the bank and its uninsured creditors, and that's going to have the effect of creating an increasing marginal cost of debt finance, similar to what John referred to as the credit surface. Okay? Now, the agency problem can take a wide variety of forms, a wide variety of asymmetric information, or costly enforcement. But a fairly common result is the introduction of a leverage constraint, which constrains the amount of assets the bank can hold to some multiple of its equity or net worth, where phi t is the leverage cap. Okay, and this is the constraint that limits arbitrage. And in the model, when this endogenously tightens, that's going to cause excess returns to go up. So what's a financial crisis here? It's a sharp contraction in either bank equity or the leverage cap. Now, I think of these as complementary mechanisms, but you can organize the papers in the literature in whether they emphasize contractions in N or contractions in the leverage cap. And let me also say, in some papers, the leverage cap is taken as a parameter, but more generally it's endogenous, and John gave you a theory as to why, for example, volatility could cause the leverage cap to go down. Okay. So how do we model crisis dynamics? Well, let's start with the evolution of equity. Equity is going to depend upon the retained earnings of the firm. This, in turn, depends upon its excess returns. What's that? That's the spread the bank is earning weighted by its leverage. Phi t minus 1 is last period's leverage multiple. So how does the crisis start? It starts with a sharp negative return on the bank's portfolio. So think about this as losses on mortgage-related securities. Equity contracts, the constraint tightens, excess returns go up, and the economy weakens. Now, it's probably clear by now that the mechanism is agnostic as to whether it's fundamentals or non-fundamental beliefs that are driving the variation in returns. In fact, in the last paper Ben and I wrote together, it was a near rational bubble that created a boom and bust in asset prices. Okay. Now, another point is that the mechanism's strength is going to be increasing in leverage, and that's fairly obvious because return variation, the effect of return variation on equity is going to depend on how much the bank is levered. So in a fairly compact way, the model captures the importance of leverage. And then finally, things can get magnified as uncertainty goes up. As John described, you could observe a tightening of the leverage cap. Now, as I said, these are complementary mechanisms, but as has been discussed, they have different implications for the cyclicality of leverage. For example, if it's the leverage cap that's tightening to generate a downturn, that's going to imply pro-cyclical leverage. It's a little trickier if it's equity variation that's driving things. As equity contracts, constraints tighten, excess returns go up. It's generally optimal when excess returns go up to let borrowers lever more. So what you get is N goes down and the leverage cap goes up, not enough to upset the contraction in N, but just goes up a little bit to relieve things. Okay, so this suggests countercyclical leverage. Now, market values measures of leverage suggest both are present. If you look at hedge funds, you find, in fact, pro-cyclical leverage. On the other hand, if you look at commercial banks and investment banks, you see countercyclical leverage. And I'll show you a picture in a second. But the object of my interest is banks, so this kind of balance sheet channel with NT variation is going to be relevant to banks. And I'm going to show you a picture that I didn't realize Daryl Duffy was going to show yesterday, but it's the same picture. This is the market leverage of dealer banks. These are most of the large commercial and investment banks. That's the blue line. The dotted red line is the financial excess bond premium. Darrell showed the LIBOR spread. I'm showing the financial excess bond premium. But you get a fairly similar picture. Bank balance sheets weaken in the crisis. The cost of bank funding goes up. And the rest of the story is this will translate into increased costs for non-financial borrowers. Okay, now this is all correlations. It's not causation. I think you get sharper results, and Ben mentioned this earlier, when you look at the panel data on banking distress transmission. And there's a huge literature that attempts to identify the effect of a change in bank balance sheet health on bank lending. And the key challenge is simultaneity, because how the borrowers do is going to feed back and affect the bank. So these papers are about clever ways to identify variation in bank net worth that's orthogonal to the borrower's economic prospects. And a recent example, I think that's pretty nice, is by Kilian Huber, who's an LSE student. And he looked at the German bank Commerzbank, a large German bank, that was exposed to the risk of U.S. Mortgage securities. And he gets orthogonal variation of N from losses in U.S. mortgage-backed securities during 2008, and he kind of makes a convincing case that this loss in MBS was independent of Commerzbank borrower prospects. There was no German real estate crisis. And then he goes to show large significant effects of this contraction on lending, on employment, on borrowers, firms dependent on Commerzbank, and also regions dependent upon Commerzbank activity. Now, I won't say this is a universal result of the literature, but it's a fairly common result that there's sort of big effects of banks' balance sheet health on bank lending. But to figure out what's going on for the macroeconomy, we need to go back to models. And what I'd like to turn to next is some recent developments in modeling. Now, one issue that the Great Recession brought to the forefront is the nonlinear dimension of financial crises. At the heart of the crisis, and Ben talked about this earlier, there was an unusually sharp increase in credit spreads and contraction in real activity, and we didn't see any of the standard large observable business cycle shocks, okay? So there's been an active effort to model this. I'd like to talk to about some work I've done with Nobu and Andrea Prestipino, and the route we take is we take the sort of model I've been describing and append on a banking collapse which is due to a rollover panic, okay? And we're motivated in part by popular descriptions of the crisis and also what the data looks like. So in the left panel is GDP growth. In the red panel is the non-financial excess bond premium. And you see that GDP is sort of sailing along, the recession starts, and through the summer 2008, it's a fairly modest recession. But then all hell breaks loose third and fourth quarter. What's going on? Well, credit spreads jump up at this point as well. What might be underlying that? Well, let's go over to the other side and look at liabilities of investment banks, broker-dealers. You see they collapse around the time of Lehman. So that's not proof of a run, but it seems, pretty suggestive of what's going on. So this is the direction we take. Okay, so how do we integrate rollover panics? Well, the first step is to add in possible fire sales of bank assets. And so this involves adding non-experts with limited capacity to absorb the securities that banks hold. So these could be households, they could be other financial institutions like pension funds, and so on. And they're limited either by their expertise or by their capital to absorb assets in a fire sale. So what happens is security prices are going to decrease as assets these agents absorb increase. So it's a rollover panic here. It's a sunspot failure of lenders to roll over short-term debt. Banks are going to liquidate assets at fire sale prices, and lenders will split them proportionately. It's a liquidity panic very much like Diamond and Digvig, but the details are going to differ because it's not early withdrawal. It's going to be failure to roll over short-term debt. So it'll be like Calvo and Cole Kehoe. Okay. So first question, when is such a panic going to exist? Well, it exists if the lender believes that all others do not roll over. The lender will lose money by rolling over. Now, what's the condition that's going to give us this? The condition that's going to give us this is if the fire sale value of bank assets is less than the obligation to lenders. Because what's true, if banks is insolvent after a rollover panic, it has no net worth, it can't operate going forward. The depositor would just lose money sticking with the bank. So here's where the nonlinearity is going to come in. The rollover panic is going to be more likely to exist as bank portfolios get weak. That is, as leverage ratios get high or the market gets illiquid, that means low fire sale prices. And 1 and 2 are going to be more likely in a recession. Okay, and this kind of diagram kind of sketches out what's going on. There's a normal equilibrium, no bank run equilibrium, where the non-experts are depositing funds and possibly holding capital directly. The banks fund assets with deposits and with equity. Suppose there's a loss on assets, equity shrinks. Since the bank is capital constrained, it has to cut back on deposits. It has to liquidate assets. The non-experts absorb them, but they're less. It's more costly for them to intermediate, so this leads to a drop in asset prices and an increase in excess returns. And this is the standard credit cycle financial accelerator mechanism that I talked about in the first part of the presentation. But it's also possible that there could be a rollover panic where the non-experts pull out, the banks liquidate assets. Non-experts have difficulty absorbing this stuff, so they absorb at the fire sale price Q star, which is below the normal market price, and so excess returns are going to be higher, cost of capital is higher, and the economy is going to slow. Okay, so we can actually take this mechanism and incorporate in a simple new Keynesian model. And I'm going to use the model for a reason, not just because it's popular. It's going to help me explain the contraction, and it's going to, as Marty said, help me explain the persistence. So we can simulate a financial collapse during fourth quarter 2008 Q4. So what we're going to do is start the economy in a safe zone pre-recession where the panic is not possible. As a recession proceeds, the economy is going to move to a crisis zone where, in fact, a rollover panic can occur. Then we're going to let the sunspot panic occur in 2008 Q4, and you'll see a financial and real sector collapse. Okay? Now, there's a variety of ways to do it. I'm going to present the simplest way and then talk about other possible ways. So the economy is in a safe zone, and we hit it with a set of negative shocks to the return to capital, and we discipline it so that the model generates a time path of investment, which is exactly like what the data tells you. Then the model is going to give us the path of GDP. That's the dashed line. The blue line is the data, and actually the model's not that far off from the data. This is all conditional on the actual path of investment. Then let's look at bank capital. We use an index of financial firms' equity. And note that the model tells you this goes down, and it actually goes down by about how much the data goes down. So what's happening here is the equity base of banks is weakening, and this moves the banking system into the crisis zone where a rollover panic is possible. Then we let the rollover panic happen in 2008 Q4. What happens? The banking sector collapses, okay? Then, so credit is disrupted and rerouted. So credit spreads or credit costs jump. The jump in credit costs causes a contraction in investment and a contraction in output, and roughly at magnitudes that we see in the data. I don't have all of the stuff you need to kind of fit the time series tightly, but at least qualitatively we can capture what's going on. Now, this is one way to generate the crisis. We are also now experimenting with beliefs. So suppose there's a period of optimism on the part of investors, then they eventually get disappointed. What happens is you get leverage buildup, an investment buildup. Then they become disappointed. What happens is they're stuck with higher leverage. The higher leverage also pushes them into the crisis zone. So we're still kind of tinkering around with what's going on here. Okay. All right. Last, let me talk a bit about policy. Now, the perspective we've been taking is that a financial crisis involves an increase in excess returns due to financial constraints tightening. Now, from the perspective of the theory, lender of last resort policies involves policies that involve reducing these credit spreads. In fact, Ben referred to this as credit easing. The term never caught on. The papers like QE better, but credit easing is actually a probably more accurate description of what's going on. Now, a very simple example would be the large-scale asset purchases of mortgage-backed securities, known as QE1. How can you think about this? This was central bank intermediation to offset the contraction in private intermediation. That is, the shadow banks were shrinking, they were unloading their MBS, and the Fed was stepping in to absorb them. And what's the Fed's advantage? The Fed was not balance sheet constrained. The Fed could fund the AMBS purchases by elastically issuing interest-bearing reserves elastically. And the evidence suggests that this worked. It actually worked to push down mortgage spreads. And I have a picture of this. The top panel is the holdings of mortgage-backed securities, agency mortgage-backed securities by three sectors. One is the institutional investors, commercial banks, pension funds, and so on. The blue, middle blue, is the shadow banks, and the shadow banks were growing and increasing their holding of MBS. Then what happens, as we've seen, the shadow banks get into trouble late 2008, and they start unloading their MBS. What's happening? Well, the light blue is the central bank. What happens? QE is announced at the end of 2008 and goes into action in the spring of 2009, and you see holdings of the Fed go up. So the Fed is essentially absorbing the stuff from the shadow banks. Now, what's going on with the spreads? Well, as the financial system, the shadow banking system, is experiencing difficulty beginning at the end of 2007. You see mortgage spreads starting to go up. That's what the theory would suggest. Then the purchases begin wholesale, and you see the spreads come back down. Now, this is just a graph of data. There's more formal econometric evidence, I think, by Annette and Arvind Krishnamurthy that shows, in fact, QE did have a significant effect on mortgage spreads. And in fact, we have models that can capture this. I've done some work with Peter Karate and Nobu. Mike Woodford has a model with Vasco Curtia that we can actually go simulate the effects of these policies. Okay, macro-pru, well, that's been discussed. I mean, the issue comes up in the macro models as well. There's a similar kind of externalities in the macro model that motivate a need for regulation. This has already been discussed here. What does the macro literature add? Well, the potential for quantitative assessment. I remember Larry Summers complaining that there's lots of models that can simulate Taylor rules, but no model that can simulate macroprudential policy. And you can think of a long-run goal of this literature. It may be like, ready at the 400th anniversary of the Reichsbank, but the long-run goal is to be able to get the model in shape to simulate the effects of macro-pru policies. Okay, conclusion. Considerable progress incorporating banks and macro analysis. Number of areas ripe for work. Ripe for more work. Let me just mention two. First of all, it's been discussed here before, but we're pretty good at modeling the collapse. We need to do more on modeling the buildup. People have already talked about beliefs. I just mentioned it here to say it fits very naturally into our framework. Something which hasn't been talked to as much here, but I think is important, is regulatory arbitrage and financial innovation in shadow banking. Almost every financial crisis involves banks getting around regulations and becoming riskier, and I think this is an important area for research. And finally, better understanding of the costs of bank equity issuance. Like here, the big problem is bank capital. Why doesn't the private market handle this situation by issuing capital elastically? At least in the context of the models, we don't have a great answer to this.